we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah. You're watching IndianOpen. Let's go straight to the headlines. Donald Trump threatens China with additional tariffs worth $267 billion as the Asian nation's trade surplus continues to rise vis-a-vis the US. RBI initiates a special audit into junk-rated IL&FS after it fails to repay SEBI. That is a Bloomberg Quint exclusive. Shikhar Sharma will pass on the baton to Amitabh Chaudhry at Axis Bank from 2019. And India's current account deficit has risen to 2.4% of GDP, higher than last year but marginally below estimates. Okay, let's take a look at how the trade setup for the day is looking like. Of course, as we've been speaking all through and through, Donald Trump refuses to stay out of action. And while there were no concrete actions taken on either Canada or China, I think the president and the US remain firmly in focus through the weekend. So the trade war rhetoric continues. Trump says on Air Force One, I might add, that he's willing to slap tariffs on additional $267 billion worth of Chinese goods. This is in addition to the $200 billion already in fray. Larry Kudlow, who is the White House economic advisor, in fact, went on to say that the US wants to build a coalition of like-minded nations to take on China. So if you were looking for some easing down on the trade war rhetoric, it didn't come about. There was some easing down on global geopolitical tension, not that it is there existing right now because of the tweets of Donald Trump vis-a-vis Kim Jong-un. But that notwithstanding, the trade war rhetoric continues. It did have a small impact on how the world markets ended because the US data was strong. However, the US markets ended lower in trade. I think Asia is taking on cues from that because if you look at broadly the rest of the Asian pack, save for the Nikkei, we're trading with a fair bit of red. Hang Seng is almost 90% off from the recent highs, another 10-odd%, and you would have it almost halving from where it was some time ago. So the world markets are in a bit of a tizzy, and the SGX Nifty 2 indicating a downside. For now, it's a 0.5% downtick that the SGX Nifty is indicating that we'll have on our markets. What came out post-market hours yesterday? Well, amongst other global factors, I think the local factors too, the macro data and current account deficit at 2.4% of GDP versus 2.5% earlier. So the number marginally off on a YOY basis, but higher crude oil prices offset the benefit of contraction in gold imports as well as rise in remittances. Indians remitted more money. There was less gold imported, but crude doing what it does, and that impacted the CAD numbers. Else the numbers could have been even better for India as a nation. What's to watch out for today? Some more macro data. Actually, not today, for the week at large, because the IP and the CPI numbers would be released later on this week. I think Wednesday is when the CPI numbers and the IP numbers come out. So some eyes will be on that. And what to watch out for? Again, not just today, but over the course of the week or the next 10 days. Remember, there's a lot of conversation around the FPI norms and what SEBI has done in terms of disclosures, etc. Now the SEBI panel has proposed vast relaxations on the contested fund ownership rules. And I won't dwell too much on it because Jayesh Upadhyay will come in and talk about this. But it's an important thing, very crucial, came out on Saturday. We'll talk about it on First Word. But this should ease the stress a little bit amongst the FPI owners if there was stress in the first place. However, at 9:05, stocks that you should watch out for. Needless to say, Axis Bank remains the top draw. Amitabh Chaudhry to be the new MD and CEO of Axis Bank after Shikhar Sharma's term ends this December. Most brokerages have given a thumbs up to this. We could expect maybe, just maybe, a little bit of rub of green as well, if at all. The markets are not exactly hunky-dory, so let's wait and watch. But brokerages arguably have argued that this is good news. We'll dwell on this in a lot of detail, but this is the news as far as Axis Bank goes. Thyrocare, remember we were speaking to Dr. Velumani just the other day about how he believed that the stock was undervalued. And boy, they've come out and approved a buyback of 8.63 lakh shares at about 730 per share. Well, a stiff uptick to the current market price. The buyback size is about 15% of the share capital and free reserves as well. So interesting announcement. Let's see if Thyrocare reacts a bit to this. And HEG and Graphite India. The Supreme Court has allowed import of needle coke for manufacture of graphite electrodes. This should be a shot in the arm for these companies. Let's see if these two manage to react today or no. This is a positive for both HEG as well as Graphite India. So let's see what happens to these counters at about 9 a.m. today. However, what's lined up on First Word today, that's very important. The HR Khan Committee recommends easing SEBI's foreign fund ownership rules. Jayesh Upadhyay joins in to tell us why NRIs may have something to cheer about. After being downgraded to junk, IL&FS will now face a special audit by RBI. Vishwanath Nair will join us with what's prompted SEBI to approach the regulator. And then we dwell in detail about Axis Bank. Shraddha and I will look into what Amitabh Chaudhry has to offer Axis Bank and the leadership vacuum that he leaves behind at HDFC Life. So talk about all of that on First Word today. Starting off with the HR Khan Committee, which has submitted its final recommendations to the market regulator, and NRIs who've been apprehensive over SEBI's April 10 circular may have something to cheer about. Jayesh Upadhyay is here now to take us through the changes suggested by the panel. Jayesh, good morning. Just the other day, we are talking about why is it that some of these fund owners or fund managers are a worried lot. Could these concerns be eased?
So as we pointed out the other day about how the panel is looking at some of the concerns that were highlighted by the NRI fund managers, and by and large they have considered the same set of recommendations that were put out earlier. And one underlying theme, most importantly, was about the prevention of money laundering norms, where it spoke about that how the beneficial ownership norms should be restricted to KYC and not towards restricting the FPIs from entering into the Indian market. So that is one key underlying theme that has now been considered. NRI fund managers, resident Indians, person of Indian origin, overseas citizens of India, all of these have been by and large exempt from the April 10th circular. Now again, these are recommendations. SEBI will have to take a look at them and then probably suggest amendments based on what the Khan panel has suggested. And I'm expecting by the 18th of September, when the SEBI board meets, these recommendations should be taken up and finally the circular should be amended. Now one important aspect that the panel has still not given out its clear verdict on is on the high-risk jurisdiction. Now, if you remember correctly, that custodians, the 5 custodians had gotten together and put out a list of 25 jurisdictions. That could have left to Mauritius being out of the ambit of being allowed in the Indian markets with complete freedom. Now, that is something that the Khan panel is saying that the government and the market regulators should develop a more evolved process of identifying the high-risk jurisdiction. So that is a space that we have to watch out for, that how the high-risk jurisdiction issue can be taken forward, because with elections coming up, that how the investors are investing into the Indian market, Mauritius being a key route, that how the investments can come into the Indian market. So that is a space we still need to watch out for.
SEBI will be looking out for comments from AMRI as well, right? I mean, the $75 billion mark had raised quite a furore. I mean, all of these things should subside. But anything else, Jayesh, that should have been left out? I think I was reading social media and people were saying that while these are good moves, maybe a thing or two could have been done more. You already outlined one key.
Is all the high-risk jurisdiction, yes.
Anything else that has been
apart from that, contention? Apart from that, if you talk about the other point of contention, something was about maybe giving a little more freedom to the NRI fund managers. Again, they are restricted at 25% and 50% and an aggregate limit. That is something they are saying that there was no need for those kind of limits. But by and large, from what we understand, they are okay with the way they have highlighted those or maybe taken those recommendations forward. One important aspect, they are saying at least still the KYC norms will still be a little more onerous as compared to what they were earlier. But I guess they can live with that. The problem was on the restriction.
Yeah, I think on social media, Jayesh, I read a comment from somebody who would have been connected to this community saying that, oh, this has happened, but the KYC will be onerous.
Of course, it will still remain onerous.
Wish this would have been done away with, but hey, come on.
But I mean, you can't ask for the moon all the time.
Yeah. Okay, interesting. Thanks for putting this into perspective. Some sigh of relief. And mind you, I mean, if people thought that these moves were the reason why the market caught a bit of cold, which of course I deferred from, but that notwithstanding, if this was probably one reason why the market thought there was some cold, some of it has been done away with. So important piece of development happened Saturday evening, and here you have it on First Word on Bloomberg Quint. The next piece is a Bloomberg Quint exclusive. IL&FS, which has just lost its investment grade ratings on Saturday, is also under the RBI scrutiny. A person with direct knowledge of the development has told Bloomberg Quint that the regulator has initiated a special audit after being approached by SEBI. Vishwanath Nair now joins us with more. Now, Vishy, tell us about this. Why did SEBI go to RBI? What's the development thereof and the implications thereof?
So a few years ago, SEBI had placed about 500 crore worth of intercorporate deposits with IL&FS and another 500 crore with a subsidiary, the NBFC arm, which is IL&FS Financial Services. Together, that's about 1,000 crore worth of intercorporate deposits that were due at some point this year, over the course of the year. So of the 500 crore that SEBI had placed with IL&FS, about 100 crore was due in August, on the 27th of August, which IL&FS defaulted upon. Now, if you default on loans, that's pretty much understood because corporate and there are liquidity issues. But when you default on deposits, that's when it starts raising questions. And that's why SEBI went to the Reserve Bank, because after that 100 crore, they defaulted on other tranches. So the cumulative amount that they defaulted upon is close to 250 crore now. Another 100 crore comes due today. So we don't know if the company will be able to pay that today or not. We'll get to know that by the end of the day. But in any case, so after SEBI went to the Reserve Bank of India with this query and asked them to intervene, the Reserve Bank started this special audit, because technically IL&FS comes under the purview of the Reserve Bank's regulations. So they started investigating, or they have started investigations into the IL&FS book, trying to understand where the money went, why the company ran out of cash at a crucial moment like this. And on the side of the IL&FS guys, SEBI has asked for a resolution scheme so that they can be sure how their money is going to come back to them. In response, IL&FS is seeking some kind of fund infusion from LIC and SBI. Both are shareholders at IL&FS. They're trying to raise some 3,000 crore from both these investors in the form of loans, as we understand it. And once that money comes in, then they will be able to pay back SEBI its due money. Well, that's what we understand so far. Yeah.
Interesting. Vishy, as I understand this, and I'm also trying to, we'll have graphics. Actually, let me just first run you through that, and then I'll get in Vishy's comment on this as well. There's a list of some of the AMCs who have exposure to the IL&FS group. Now, we'll get you scheme-wise exposures as well a bit later on. But this is the total exposure that AMCs have to IL&FS debt. So Aditya Birla Sun Life about 1,600 crores, DSP BlackRock 800 crores, UTI Retirement Solutions 617, LIC Pension Fund has 563 crores, Kotak Bank about 130 odd crores. So these are the 5 large ones, and then there are sub 100 crores from multiple asset managers, SBI Pension Funds, UTI Asset Management, Max New York Life, IFCL Asset Management, etc., etc. So the total exposure as per Bloomberg coming to about 4,125 crores. As I understand this correctly, the downgrades have come in. It's not default as yet. It's junk status, not default as yet.
Yes. So as and when that default comes in, of course, I mean, already there's going to be some kind of mark-to-market hit for all of these investments. Once it goes into default, then that's when the problems start to come in. Because IL&FS will get about 3,000 crore if they get the approvals. We're not sure yet. There was a meeting on Friday. But once that money comes in, then they'll be able to pay up some of the outstandings. But as you mentioned, about 4,000 crore worth of paper with these mutual fund houses. So again, all of these will come knocking at their door, and then that's when the company will have to start repaying all of these investors.
And by when do you expect, or by when can one expect this approval for the 3,000 crores to come in?
Well, ideally it should have come on Friday, but there has been no news. The meeting, as we understand it, went on till late. Over the course of the day, we'll come to understand whether LIC and SBI are willing to pay that money. But yeah.
Well, interesting times. Let's wait and watch. Some of the MF investors will be a worried lot as well. But Vishy, thanks for putting this into perspective. You may want to stay on actually, Vishy, because the next piece that we're talking about is Axis Bank. And good to have both Vishy and Shraddha with this, because HDFC Life's Amitabh Chaudhry will now head to Axis Bank. Chaudhry has received RBI approval and will succeed Shikha Sharma as the MD and CEO starting the 1st of January. Now, here's some things. I'm sure both Vishy and Shraddha, who are with me on this piece, will be wanting to talk more about this as well. Axis Bank now has a new leader all over again. And a lot of watchers, maybe even Vishwanath, maybe even Shraddha, over the years would have seen that there is a new person at the helm of Axis Bank, or erstwhile UT as the case may be, almost every 9-10 years. So Amitabh Chaudhry, appointed MD for a 3-year term, I might add, from Jan 2019. Shikha Sharma, MD for a little over 9 years. I think come end December, it's about 9.5 years, if I'm not wrong. And PJ Nayak was MD for nearly 9 years, slightly less than 9 years. I think his term ended 3 months before it was due to end, so slightly less than 9 years. But more importantly, guys, there is a new deck at the top of Axis Bank, right? Amitabh Chaudhry, as commendable as his leadership is the new MD and CEO. Siddharth Rath, I believe the head of corporate banking, quit recently.
Yes.
And V. Srinivasan's term, Deputy MD's term, to end very, very shortly.
And by December, yeah.
By December, right? So while there are a couple of other people still out there, but a large portion of the top management team out of Axis Bank, so a bit of a vacuum which gets filled in by Amitabh Chaudhry, yes, but they need other hands to come in.
Yeah, so most of this is on the corporate banking side that they've lost out, because Srinivasan as well as Siddharth Rath both were in charge of the corporate banking divisions. They were leading that charge essentially, while their retail banking is still strong, and Rajiv Anand is heading that, and that's still going on. You know, once the cycle turns and once more borrowers come online and they start looking for options, Axis will have to take a call whether they want to be in the infra game or not. The last outing was not that great. So this round we'll have to see if they're actually interested in that game at all.
Yeah, interesting. And what of course stays with them, a small piece, is that the investment banking piece, the deal management piece, something that was very close to Shikha Sharma's heart. It was the first thing that she did when she came on as MD and CEO. Still remains strong because that piece does not get impacted. But Shraddha, what is also interesting is what Amitabh Chaudhry's appointment means, right? The RBI approval is in place, so that overhang goes away. You have a proven leader with proven capabilities in his past in earlier roles coming in to helm this, and yet again Axis has an outsider coming in with insurance experience to head the bank.
Yeah. You know, just to mention in brief about how HDFC Standard Life has done during Amitabh Chaudhry's tenure. He joined in Jan 2010, but if you look at the FY11 to FY18 period, the total premium income for the company has risen at a CAGR of near 15%, from a net loss of 99 crores in FY11. The company reported a net profit of 1100 crores in FY18. AUM has grown at a CAGR of 22%, while embedded value has grown at about 20%. So yes, this proven leadership through his career is set to be positive for Axis Bank. In fact, analysts had earlier said that the upside in Axis Bank could be capped until there is more visibility on a new CEO. So overall, it is believed that an external candidate could bring in fresh thoughts, and there could be some sort of a rebuilding of credibility with the investors. Question, of course, Neeraj, remains whether the new CEO will focus on NPA cleanup. It is believed that in case of Axis Bank, most of it is already done, but whether he will focus on the residual cleanup for the first 2-3 quarters of his term, or will the focus actually shift to earnings revival. Having said that, Edelweiss believes that while this is a strong management move, further re-rating for Axis Bank will be driven by asset quality performance and some sort of visibility on all these execution changes that they are set to make. They have revised the target price higher from 543 to 647 by maintaining a hold. Motilal Oswal has said that Chaudhry's vast experience in technology front will aid the bank as it builds upon its digital capabilities. They have also said that there is a possibility that the business mix and loan growth mix or strategy might actually change, and they, in fact, they've also gone ahead and said that Axis Bank could possibly they take a step further and enter into the life insurance business, especially with Amitabh coming in. So overall, they believe that this overhang is gone. They see that after a painful 3 years, earnings growth momentum could pick up for this bank. They've also mentioned that their target price has been again hiked to 750. Having said that, Axis Bank shares have already run up about 18% or so since the start of August. So I'm not sure if this sort of momentum can continue, because speculations are already rife about Amitabh Chaudhry joining in. What it means for HDFC Standard Life, Neeraj, in the short term, some of the analysts have highlighted that it could really lead to some sort of a vacuum. Nevertheless, it's a big institution with solid metrics, so it shouldn't be difficult to find best talent. And Motilal Oswal again has said that it don't see any disruption, so they maintain a buy rating with a target price of 525.
Yeah, and maybe some implications for Max Life if Axis Bank decides to tie up with other companies, including HDFC Life for that matter. So we'll get to know about it when we get to know about it. Just a thought out here, as is everybody's you want to react to news, but everybody knows that Axis Bank was on the hunt for leadership role. Yeah, Amitabh Chaudhry may not have enough banking experience in the past, but is a man with proven track record. This is arguably as good a piece of news for leadership of Axis Bank as it could have been, right? I mean,
Yeah.
almost everybody that I spoke to seemed to agree with that.
His background is still foreign banking, so it's not like he's completely bereft of that banking side of the story at all. But interesting point that Shraddha also mentioned about the NPA performance. Now, typically when we, over the last few years that I've been covering banking, the focus has always been kitchen sinking in public sector banks, and that's where it usually happens because leadership changes almost every 2 years. But now we're talking about kitchen sinking at private sector banks as well, because we'll get to know in the coming few quarters, once he joins on the 1st of January, then the first quarter next year, we'll get to know whether there is such a problem at all, or if Axis's NPA issues are all settled over the last 2 years. Last 2 years has been quite cruel for Axis Bank, because not only did the RBI's AQR push the NPA numbers up, the bank itself sort of fastened its seatbelts and try to go after the NPA book, the stress pool, try to classify as many accounts as NPA as possible, so that the book is cleaner. But of course, once the new leader takes over, that's when we get to know whether there's more left stuff that we were not aware of earlier.
Yeah. Well, and we have at least 1 quarter, if not 2, when the current management and not the new management will be declaring the numbers, have a chance to maybe declare more, clean up the books a bit more if it's needed. As Shraddha said, though, that a lot of people believe that some of the Axis Bank cleanup has already happened, maybe all of it or most of it has already happened. So we'll get to know about it. The last thing that, guys, I want both of you to come in on is the interesting scenario that the private banking space finds itself in from now on until the next 2 years, because a lot of leadership changes will happen. Some faces that we are used to for years now will be making their way.
Right. In fact, Neeraj, I have 2 interesting points to make on this. One is that so far, while the challenges for PSU banks have been with respect to NPAs, recoveries and growth issues, this entire, large private sector bank is now going to be facing the challenge of succession planning and bringing in new leadership. So that's one aspect, that this is the challenge that they have to deal with, even as they're not struggling with NPAs, not all of them. On the other hand, while it is believed that some of these larger banks have a large depth of management and they become process-driven and institutionalized. So over the long term, probably this will not really be a challenge for these banks, but you don't know if this continuity will have some short-term impact. And, this again brings to the fore this private versus PSU bank debate.
Yeah, Abhishek, anybody that you've been speaking to who's been talking about this even remotely? Because I know most people in the market tend to believe that because these banks are not necessarily leader-driven, but process-driven, these changes will not have a material impact.
You could say that, but the growth cycle, while they're all large institutions and there are plenty of senior people manning the various sections in the bank, remember that the growth that has come in the last 10 years has come because of these leaders who are now on their way out or have already stepped out of the bank. So that needs to be taken care of, and whether the new leadership that comes in, whether they will take the same calls or whether they are the same believers in that faster growth, because remember that growth also came at a price. It didn't just happen, it didn't just benefit the bank. Eventually it also led to some asset quality issues. So how they balance that the high growth as well as having a good risk management practice on their bank books. So these are matters which will come to light, and we'll discuss more in the next 2 or 3 years, and get to see how these new leaders perform.
Yeah, but very interesting times if you're a private bank watcher, not just from a stock perspective, but from the industry perspective, how come 2021, a whole new set of people will be addressing the earnings calls as well. So that's interesting, something that I'm looking forward to. But Vishy as well as Shraddha, thanks for putting this into perspective. Axis Bank remains firmly the stock of the day to be monitored. Well, that's all that we have on First Word today, though. Lots more lined up. We'll talk about the impact of weakening rupee on the rising public debt with Sajjid Chinoy of JPMorgan. We take a look at challenges and opportunities for Info Edge with Managing Director Hitesh Oberoi. But after this break, since we're talking about Axis Bank, a full tilt towards the day's trade and get in an analyst to speak about the impact on Axis Bank as a stock in the near term. So we'll talk about that as well in just moments from now. Stay tuned.
Good news, got a promotion and a damn good raise.
Congrats, beta.
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले.
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना सेम चॉइस। LIC
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद।
Dreamers, they're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are no different. They are you. When you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
September 15th, 2008. The day a titan of the investment banking world fell. An event so unlikely that when it happened, it shook the world economy. 10 years later, the world has picked up the pieces. Or has it? Bloomberg Quint looks back at the collapse of Lehman, its aftermath on India, and the recovery that followed. Lehman, a decade later.
Kerala is tiding over the worst calamity that the state faced in a century. The intensity of the calamity and the losses suffered thereby are unparalleled. A preliminary assessment pegs the loss at around of rupees 20,000 crores. It is a humongous task to undertake various tasks of rehabilitation and reconstruction. Only with the wholehearted support and cooperation of all of you, we can rebuild Kerala. Your contribution, however small, will go a long way in achieving this goal. Please contribute to the Chief Minister's Disaster Relief Fund. We shall overcome.
Welcome back and good morning to our viewers. We're watching Indian Open right here on Bloomberg Quint. Let's quickly take a snapshot of what's been happening across markets before we get our trade set up for today. So Asian markets trading slightly more mixed bag after investors have digested Donald Trump's threat for more tariffs on more than $200 billion worth of goods. So that's not weighing down too well. Nikkei is flat. We've got the Hang Seng now down 1%. In fact, just to tell you, the Hang Seng from its January highs is down almost 19%, which means it's just 1 to 1.5% away from entering into a bear market. So that's a big cut coming in for Hang Seng. As you can see, that's the bear market territory, and we're just a smidge away from it. So closing in pretty fast, actually, on the kind of moves that we've been seeing across Asia. For our market, the SGX Nifty and the positioning that we are at this morning, 0.5% cut, so weakness that's coming in for our markets is at 11,587. Remember, we're coming back of last week where after 6 straight weeks of gains, the weekly close was negative for the index. You had some shorts building up in the system. Agam is joining in right now to take us through more details. Agam.
Well, so we did have some gains when it comes to the benchmark indices last Friday, and that was evident in the kind of changes in open interest that we saw. We did see about a 2.3% increase in OI, so some longs building when it comes to the Nifty futures. But the Nifty banking index was absolutely flat, and there was no change whatsoever when it comes to its open interest, as you can see here. Let's move on, take a look at the India VIX. That's edging towards the mark of 14, and I reckon some traders out there will start to get, well, they'll start to take short positions should we see the VIX move above the mark of 14. So that is going to be crucial. But in terms of other variables, we have the open interest change, and it is essentially the 11,500 put where we've seen more writing coming through. That's also the one with the maximum open interest and a lot of activity around that mark. Of course, when it comes to the call, the max OI is at around 11,800. The Nifty put call ratio has edged up higher to around 1.49 as against 1.39. And in terms of stocks, keeping an eye on something like a Nestle India, which has once again seen a little bit of a reversal after the kind of weakness that we saw through the course of the week, and longs building in there. We also have longs in Godfrey Phillips, which advanced by around 4%. On the other hand, Adani Enterprises has seen shorts building up with a decline of around nearly 4%. And along with Adani Enterprises, we have seen some weakness in Yes Bank as well, which declined by around 4.7%, with 24% added in open interest towards fresh shorts. We'll be watching out for, well, mixed cues coming through in the futures and options space. Let's watch out for how the benchmarks open in today's day of trade.
All right, Agam, we'll leave it at that. Thanks very much for joining. And well, on to the big piece of news that's going to probably see a bigger reaction on the stock price. HDFC Life's Amitabh Chaudhry will now head Axis Bank. Chaudhry has received the RBI's approval and will succeed Shikha Sharma as the MD and CEO starting the 1st of January. How will the street view this appointment? Let's ask Siddharth Purohit. He's a research analyst at SMC Institution Equities. Siddharth, good morning to you. Thanks very much. Well, looks like the street is very optimistic on this appointment, but how do you see, the way down once his term comes into play?
Yeah, good morning. So, in fact, if you look at definitely this new induction of Mr. Chaudhry in the as a leader will definitely have a positive impact, and that is what the market had been sensing, and probably a new way of working could probably change the way the bank had operated in the last few years. It's not that something will drastically change, but Mr. Chaudhry already has a very good track record of handling multiple functions at very quickly. So all positive, but all depends on how the asset quality is controlled by the new management going ahead. Because if you look at the last couple of quarters, the only problem of Axis Bank was not actually the growth, it was the asset quality that was creating problems. So growth was still there. So even retail growth, if you look at it, was at par with other, any other large private bank. So growth was not a concern. So they don't need to probably propel further growth, but all they need to do is right now probably control asset quality, which also had started seeing some sort of stabilization in the previous quarter. But probably this quarter, there would be some more marginal and rising NPA. So one has to deal with that. But I would believe that, maybe, there could be fresh strategies towards, fresh lending towards better rated corporates for the new management, and then market will react accordingly. So overall, I think it's a positive development. But of course, there has been a lot of rally in the stock in the last couple of months' time. So one needs to factor into that also.
Would there be any changes from the target price of the stock actually from your end? Because the stock's already run up 23% in the last 2 months in anticipation of this appointment, of a new chief at Axis Bank, and the fact that they're at very early stage of improving the NPL cycle. So all these factors put together, does the target price increase significantly at your end?
No, our target price doesn't change as of now, because as I earlier said, no doubt, the new management will come in, there will be new strategies also. But the key issue still remains how to handle the asset quality. Because if you look at, as I earlier said, growth was not a concern. So it was only about how the entire industry pans out in the next 2-3 quarters. And even the previous, leaders have always mentioned that, the second quarter probably would still remain little, high in terms of NPA, and the second half of FY19 could see some normalization of credit cost. So earnings visibility doesn't improve immediately. FY19 will still be a challenging year. So probably FY20 could trade. So, and as you rightly said, the stock has reacted positively in the last couple of months' time. So from here onwards, possibly we'll wait for the right point to enter rather than upgrading the target price at this point.
Siddharth, just one question from my end. Does your target multiple for Axis Bank improve as a result of Amitabh Chaudhry being at the helm now? Because the other things we'll get to know when we get to know about it when his term takes on. Right now, immediately, do you up the P multiple or the price to book multiple for Axis as a result of this announcement?
I don't think we'll be changing that. The reason being it all depends on how performance really evolves over the next couple of quarters. And one needs to wait because it's still time before he takes over the lead role and then starts delivering. So I think we need to wait for 2 more quarters before really re-rating the stock. And the stock is already kind of certainly it has run up. So I think one needs to wait before getting into fresh way into the stock.
Okay, appreciate your time, Siddharth. Thanks so much for being with us today on Bloomberg Quint. Well, Axis Bank certainly was one of the outperformers last week in Friday's session as well. That stock did reasonably okay for itself compared to some of the others which cracked, the likes of Yes Bank, for example, or SBI, which were down in trade. But lots more to the markets. Autos had a big day in Friday's session, ending the week on a good note. So much more to speak about. Avinash Gorakshakar, Head of Research at Joindre Capital Services, joins us right now on the show. Avinash, good morning. Thanks for joining in. If the worries are out of the way, there are a couple of pockets which are showing that. Autos, for example, really smart moves in Friday's session too, but over the week as well. What are you doing currently in the markets? Are you shopping? If you're shopping, where is it that you find favor in the large cap space?
I think within the large caps, Neeraj, we find M&M quite interesting. Our sense is that both the UV as well as the tractor business continues to be, well positioned. In fact, the UV business should now get a good kind of growth momentum, considering that they recently launched a new MPV, and I think the kind of response the company has got, I would believe that even the UV basket would now show a strong double-digit growth. As far as the tractor business is concerned, our sense is that tractor volumes continue to be healthy despite a larger base. And more importantly, if you look at the consolidated structure for M&M compared to maybe a Maruti, M&M has always underperformed. So our sense is that at this price, probably even an entry at this level could give a decent risk reward. Clearly, I think it remains a more stable company compared to a more focused player like say an Ashok Leyland or a Tata Motors. So I think clearly within the auto pack, M&M looks definitely well positioned.
What about Tata Motors now that we know that Jaguar Land Rover total retail sales for the month of August was down 4.9%?
See, I think in the short term, Devina, the stock is going to underperform. I think the management commentary post the analyst call was clearly evident that margins, at least for the next couple of quarters, are going to remain under pressure. And since JLR is a large piece of the revenue and profitability, our sense is that this stock could definitely underperform for some more time. Numbers could still not improve, say, beyond maybe another couple of months. And only once we see a recovery in the volumes, especially for JLR, one could see a little amount of value being coming in. But as of now, I would believe the stock could remain where it is. I think I don't see any immediate earnings triggers which could drive the stock.
All right, just stay on with us. In fact, since we're on the topic of auto, we've got our research analysts here to talk a little bit more on what's been happening in Bajaj Auto. We'll get to that, but we've got some calls in the financial space as well. We've got Shraddha, Nikki, Yatin joining, and I'll start off with you, Nikki, with Elara's call on financials.
Sure. Elara Capital on Magma FinCorp has initiated a buy rating with a target price of around 190, which indicates a potential upside of nearly 34% for the counter. Visible transformation in terms of the ongoing restructuring, according to the brokerage, has started paying dividends. Improving trajectory is what the brokerage has noticed. It's AUM CAGR of sees AUM CAGR of around 17% over the next 3 years. It expects the credit cost to fall to 2.1%. 9% by FY21, thereby improving the return on assets. Elara Capital on M&M Financial also has initiated an accumulated rating with a target price of around 501 per share, which indicates a potential upside of 9%. It sees the CAGR of assets under management over the next 3 years at around 18%, says ability to sustain NIM, revamp vertical structure and stability to AUM growth is a great positive for the company. In terms of the earnings CAGR over the next 3 years, it says a 30% growth there. Next we have a Shriram Transport Finance, where the brokerage has initiated an accumulated rating with a target price of around 1,324 per share, which indicates a potential upside of nearly 10%. It says that the FY19 performance holds the key, and it also expects some kind of a reversal in credit cost from the peak level that we are witnessing currently in FY18.
All right, Nikki, thanks a lot for that. Yatin, Bajaj Auto?
Devina, two developments here. Number one is the price hikes that they have taken in CT 100. So the 100cc segment in the two-wheeler space had been witnessing some strong competition, but now Bajaj Auto has raised the prices after cutting it by 1 to 4% range. Remember, the management said that they do not make any substantial profits in CT 100, and that created a lot of competition between Hero MotoCorp and Bajaj Auto. So clearly, at this point in time, it seems like the competitiveness in the 100cc segment is reducing substantially. Probably this will lead to some bit of earnings uptake, according to Goldman. Also, Goldman has pointed out the fact that the recent rupee movement and the kind of three-wheeler management guidance which has been given, that is quite encouraging. In fact, if you look at the recent rupee depreciation plus the kind of export market that they have in terms of the overall sales, which is 40-45%, that will lead to an improvement in terms of realization. Also, they expect the average selling price to increase on the back of higher INR weakness as well as the recent price hikes. Apart from that, we have the three-wheeler space, and the government also has been looking to do away with permits for alternative fuel three-wheelers. So probably on that front, Bajaj Auto gains a lot, and that is the reason why we have some earnings upgrade coming in from Goldman Sachs for Bajaj Auto.
We did see the stock price also react to those that news. Shraddha, you've got some more stocks news for us.
Yeah, so positive development for HEG and Graphite India, as the Supreme Court has allowed import of needle coke for electrodes. You have Thyrocare Technologies, which has approved a buyback of nearly 15% of the company's equity. They fixed the buyback price at 730 per share. That's a near 14% premium to Friday's closing price. You have Sorrel Infra Resources, which will be raising 550 crores in total, of which 440 crores will be infusion from the promoters and 110 crores will come from a non-promoter entity. This will be done via issuance of convertible warrants, for which the price has been fixed at 550 per share. The key here is that it is at a 28% discount to Friday's closing price. We could possibly see a negative reaction there. Rights Limited has won a contract of about 295 crores, not a very big one for this company, nevertheless could react or see some minor positive reaction. And finally, Info Edge will be in focus as well, and that's on the back of a Times of India report which says that China's C-Trip is in talks to invest about $400 million in Zomato, which is in which Info Edge holds a sizable equity, and that values Zomato at about $1.8 to $2 billion. So Info Edge is a stock to watch.
All right, guys, thanks a lot for that. So many more stocks to watch out for. Avinash, a quick call on the NBFC space, and do you like anything here?
I think within the NBFC space, we continue to like Shriram Transport and M&M Finance. In fact, M&M Finance has clearly shown a strong bounce in asset dispersals, and the asset quality has also shown a decent improvement. I think more importantly, the rural pickup for the company has improved significantly, and our sense is that not only the tractor business but the commercial vehicle business has also done well. So I think M&M Finance over the next, say, 12 to 15 months should definitely show a stronger traction in earnings and better asset quality stress. And more importantly, if one were to look at Shriram Transport, the stock has been hammered from a high of almost 1400 plus levels, and our sense is that despite the fact that the market is fearing an interest rate hike which could possibly impact its margins, the company is confident that it's taken a price hike and possibly that could cover up these interest costs. And more importantly, the kind of overhang on the SVL issue, I think once it gets cleared, the stock should get a better kind of re-rating.
Interesting. This import of needle coke for graphite electrode manufacturers, how big a shot in the arm for HEG or graphite?
I think it should be, because needle coke anyway, Neeraj, is not made in India. It is anyway imported entirely, and I think this definitely should help companies which actually are into electrodes. I think graphite as well as HEG should definitely benefit. Our sense is that what kind of pricing gains these companies make on this input is very important. Overall, I think the pricing both on the electrodes as well as on the needle coke prices had gone up. So clearly availability was an issue. So I think clearly what kind of pricing gains these companies make would obviously be later on. But overall, it seems to be a positive.
Well, let's wait and watch. The judgment came out, I think, Friday or thereabouts, and we have had the weekend to digest this piece of news. Maybe it results in some bit of optimism for HEG and graphite. The last 1 month haven't exactly set the stage on fire. Maybe this can change it. Well, talk about that and more in just moments from now. But 8:45, time now to focus a bit on the technicals of the market as well. Let's get in our technical experts on board. Amit Harchekar, Director at Index Genius Investment Advisors, and Bhavin Mehta, he's derivative strategist at Dolat Capital. Both of them join us on the show. Gentlemen, both of you, good morning. Thanks for joining in. Amit, we're likely to start off marginally lower today. What are the charts indicating? What's the trade for the day or for the week?
Well, so far the derivatives data in Nifty seems to be extremely positive. Earlier also I had mentioned the moment it crosses that 2.65 crore mark, new positions is getting built on the long side. And despite a lower opening, even on Friday's trade, we managed to close in a very solid terrain. We believe this open interest tally has more scope to move upwards. The upward projection of this open interest falls in the range of 3.10 crore remains the first barrier. If that gets crossed, the next barrier is near 3.5 crore to 3.6 crore. So we believe, since we haven't seen any open interest unwinding during the market fall, we believe that it's long build-up which is taking place in the Nifty futures, and we expect now Nifty future to move towards 11,800, 11,815 from 1 to 3 days perspective. Now stop loss for your long trade would be at around 11,520 on a future. The reason why we are saying is the current series VWAP for Nifty future is placed at 11,620, and hence we would recommend a stop loss of 100 points on a closing basis for your long positions.
Bhavin Mehta also here with us to take us through his ideas. Bhavin, first up on the index.
Good morning. I believe that for markets, it's going to be more of a ranged trade between 11,400 to 11,800, considering the entire expiry. As far as today's trade is concerned, I believe that initially, definitely, we are going to see a knee-jerk reaction in the markets. At the same time, on downside, as long as 11,400 is held, I think one can continue to write lower strike puts. The moment Nifty spot is able to close above 11,600, I am anticipating good amount of short covering, which itself can see Nifty moving closer to 11,800. So view is positive. Initial knee-jerk reaction in the market should be used to create short position on the put side.
Let's run through some of your stock ideas as well, Bhavin. You've got Sun Pharma and you've got a sell on Yes Bank.
That's correct. So what I'm anticipating is that on Friday's trade, we have seen Sun Pharma holding on strongly despite negative news flow. And overall, pharma index continues to trade with very good amount of strength. And overnight, we have seen good amount of strength coming in for dollar index as well. So I believe this remains positive for pharma and IT both altogether. So anticipating a long on Sun Pharma even in today's trade, initial weakness should be bought into with stop loss of 640. I anticipate stock to move closer to level of 700. On other end, Yes Bank has given a negative breakdown, closing below a level of 325. Anticipating good amount of weakness in this particular counter. It has just failed to move past level of 350 on the upside. So as long as it stays below this particular level, one can continue to short, probably in the range of 325 to 328 with stop loss of 335 and target price of 310 on downside.
Interesting. Amit, what about you? Your ideas for the morning?
Well, I have a 3 buy call and 1 sell. First call would be buying Concor futures with a stop of 625 and a target of 700.
The reasoning for this is, if you see Concor on the medium term chart, it has given a very strong breakout from bullish flag, and we now expect a rally of at least 7 to 8%. Apart from that, first time in last 8 months, we are seeing a strong reversal in Nifty PSE index, public sector enterprises. There we are now expecting an upside of at least 8 to 9%, and that should help stocks like Concor, NTPC to run in the near term. Second pick would be buying NTPC futures. Again, NTPC, since it becomes a heavyweight in Nifty public sector enterprises, we anticipate a good rally in NTPC from current levels. We are expecting our levels of around 184 to 185 in the coming days. Now, stop loss for your long trade would be 163. Last call would be, third call would be buying HDFC Bank futures. Now, on stochastic oscillator from extremely oversold terrain, we are seeing a bullish triangle for getting formed in HDFC Bank, and we think now there is a very limited downside for HDFC Bank from current levels. So we would recommend buying HDFC Bank futures with a stop of 2020. Our short-term target remains at 2150. And last would be a sell call on OBC futures. The reasoning is OBC has given a triangle reversal after a recent rally, and now we are expecting a fall of at least 8 to 9% in the coming days. So we are suggesting going short on OBC futures with a stop of 80. We are expecting target between 70 to 72 levels.
All right, many strategies there from Amit, so watch out for them in intraday trade as well as over the short to medium term. But time now to go on to a special segment, Bloomberg Edge, where Jayesh Kilnalni tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Jayesh, what's the stock on your radar today?
Morning, Devina. It's Reliance Industries, and the stochastic indicator has given a clear buy signal on this and suggesting that, there could be a resumption in the uptrend after the minor pullback that we saw in the last few days. First, let's have a look at the stochastic indicator and what are the conditions behind it that you need to watch out for. Well, it helps you to identify when the price move is actually overextended by measuring where the current price is in context to the recent high or the recent low that the stock would have formed for itself. Few conditions that you have to keep in mind is overbought level is placed above 80 and the oversold is below 20. There are two lines which get plotted on this chart, and a crossover between those two lines gives you the buy and the sell signal depending on the direction of the crossover. With that theory in mind, let's have a look at the chart of Reliance Industries, and we can see that the stock has continuously been making higher high, higher low patterns in this year itself. And you can see this is the minor pullback that I was referring to, from excess of 1300 levels to just about 1220, 1225 levels. And you can see that last couple of days there are a couple of green candles which have actually paused this particular minor pullback that we saw. If you look at the bottom panel, which shows you the stochastic indicator, zooming into this will show you that the blue line has comfortably crossed above the white line, and both of them are above this green line, which means that there is definite confirmation of a buy signal for Reliance Industries.
And this particular indicator, how well does it work for Reliance?
Neeraj, works very well given the weightage that we have on Reliance. Last 1 year, if you had bought all the indications given by stochastic alone, net profit would be about 27-28%.
Well, thanks, Jayesh. Thanks for putting that into perspective. So, well, the charts on the terminal indicate that there could, or the indicators on the terminal indicate you could go out and buy a Reliance from a trade perspective. From an investment perspective, Avinash, Reliance Industries, telecom business starting to do well, retail not doing all that poorly, at least whatever is reported. And the petchem business has shown some new sparks in the last couple of quarters, at least if not longer. Would you buy Reliance? Would you invest fresh money into Reliance?
Yeah, I think, Neeraj, if you see the kind of growth trajectory on the telecom business, I think they have managed to actually grab market share from most of the other players in the market. And I think the the oil business as well as the petchem business showed very strong kind of margin enhancement in the Q1. Our sense is that even in the Q2 this kind of momentum would continue, and I think FY19 is going to be a lot better for the core business as well as for the geo business. So I think if you have a timeline of at least next 12 to 18 months, I think Reliance is definitely all set to deliver a very strong set of numbers, not only for the coming 1 or 2 quarters, but FY19 should see a decent earnings growth driven largely by the geo business and obviously by the petchem business, which now would be aided both by pricing as well as expanded capacity.
The other pocket obviously that you should look at in relation to this is obviously what's happening with regards to the pricing here with the steepest price hikes that have been taken in petrol and as well as in diesel, with Mumbai petrol prices crossing 88 rupees per litre, Delhi now at record highs, and whether or not the government actually does something to bring that under control, which is what the demand has been, because the excise duty taxation element in fuel prices is maximum. So about 19.5 rupees per litre is just the tax factor within the fuel prices. So whether or not the centre actually comes in and says, okay, I'll reduce the excise duty for now, but they're refusing to do so because they're like, we don't want to come in because crude is very volatile at this point and we don't want to take any steps at this point. And that's probably the reason why this bund is happening today.
Yeah, well, whether or not that's successful or not remains to be seen. But Avinash is right. Avinash, the impact that this has on consumption, etc. What would your view be on the OMCs as well, individually?
No, I think clearly, one would have to see what kind of impact it could make. But clearly, if the petrol and diesel prices continue to keep going up, you are definitely going to see the volume throughput and the volume, growth getting impacted, at least in the near term. I think the government has its own reasons for not cutting excise duty. But overall, I think if crude prices continue to remain firm, there is no choice since this is a free market. I think we are going to see these prices getting more higher and higher. And I think demand definitely at some point of time would definitely be a little impacted because of these kind of price hikes.
Avinash, the other stocks which come into focus as a result of what happened in Axis Bank is obviously HDFC Life.
Yeah.
Now the stock has corrected a little bit from the highs. Amitabh Chaudhry is going to vacate his post. Does it have a material impact on HDFC Life as a stock?
Neeraj, I don't think an institution like HDFC Standard Life would be impacted seriously. But yes, in the near term, it could be a sentimental kind of news flow which could make the stock a little bit weak. This is a long-term business. I would believe that if anybody wants to take an exposure in this stock, I think this could probably provide a good entry point because obviously they would be looking at a new CEO to come in, and I think business would be back to as it is normal. So I don't think this is going to have any material impact on the balance sheet or the earnings. Maybe in the near term, the stock could remain weak, but that is just a sentimental factor. I think nothing to do with the fundamentals.
So what levels, Avinash? It's 451. Let's assume there is weakness here. Would you be comfortable accumulating it at about 430, 420? Or even at the current levels?
I think, Neeraj, if at all it comes down to say around 425, 430, I think in these stocks, I think I would personally take a 2-year view because the kind of opportunity which we see in the insurance space and the kind of positioning HDFC Standard Life has, I would believe that this could definitely give a strong risk reward provided the timeline is slightly longer. And I think anywhere between 430 to 450, the investor can definitely get in. My sense is the stock may not react all that negatively at all. I think, we are hoping that the stock could open weak, but clearly if it does open weak, I think it should provide a good entry point.
From a technical perspective, while Axis Bank has done 23% in the last 2 months, HDFC Life, on the other hand, for the last 3 months has been giving negative returns of about 3 or 4 odd %. Amit, do you want to comment on any of these two stocks on just price levels and whether or not there are entry points here?
Well, I would say from relative strength basis, Axis Bank remains a preferred pick even on a decline, because as long as the stock stays above 630 on a weekly closing basis, the near-term target falls in the range of 685 to 690. So I would prefer Axis Bank even if there is a dip of 2 to 3% in today's trade. HDFC Life, again, the structure remains weak and there is a potential risk of downside of at least 425 to 430. So that should be the area where stock can rebound, but I'm not that certain whether that could act as a reversal. So there could be a bounce. If it's not supported with volumes, then this rebound could turn very short-lived.
2 stocks, Friday session, in fact 3 stocks that on Friday session did really well, volumes picked up. Hathaway Cable, which was up about 12%. You had a Suven Life Sciences, and that one's been on a roll, since a few days now. The stock was up 10%, and a Jubilant Life Science, which was up about 8% odd. Bhavin, any of these 3 stocks that get your attention?
Okay, liking pharma sectors on a long side, I believe Suven and Jubilant will continue to move higher. There can be certain amount of profit booking at higher level, nonetheless should be used to accumulate the stock. For Jubilant Life Science particularly, I believe that stock is moving closer to level of 900 now. Very good support, very good accumulation we have seen in the range of 740 to 750. So I believe this will continue to act as good support point for the stock. As long as Hathway cable is concerned, there is clearly a good amount of hurdle in the range of 26 first and then around 28, 29 levels. So as long as stock is not able to break above this level, I would recommend anyone who is holding this particular counter to book some amount of profit at higher levels. At the same time, any weakness below 20 should be used to exit on the long side.
All right, gentlemen, just stay on with us. We've got about 30 seconds left to go for market pre-open. The setup looks weak this morning. The SGX Nifty is trading under by about 0.5%, and the rest of Asia also is not doing anything much. You have the additional tariffs, weighing down heavy on sentiment across Asia. So Shanghai is down about 0.5%. Hang Seng approaching that bear market like we spoke about earlier. It's down about 1% now, so no respite coming in from there. For our markets as well, while Friday's session in particular was not bad, the week itself was, not up to the mark. So after 6 straight weeks of gains, we took a dip there last week. But that's the pre-open trade for you. Up about 0.5% on the Nifty, 11,638. Sensex trading higher by about 0.7%, 38,668. Taking a cue from stocks, and the first one that you need to look at is what's happening to Axis Bank. Not a very big reaction, just about 1.5% higher. So very muted. The stock's already seen a big run up in anticipation of this. So we've spoken about that. May not see a very big move on the upside, though consensus target somewhere around 750 odd rupees. Still 100 rupee upside from here, but 655 is where it opens up at. HDFC is up 2.6%. SBI is moved up 2.2%. You've got Vedanta up 2.2%. Infosys, Bharti Airtel, Grasim, all are up anywhere between 0.8% to 1% apiece. Hindalco in the metals pack is up 0.5%. L&T moves up another 0.5%. Then you've got the likes of Yes Bank, which is flat but marginally in the green. Amongst the losers, Tata Motors, a big dip. JLR volumes dropping in the month of August by 4.9%. The stock takes a knock of 5.9% now. Ultratech Cement, Titan and ONGC also losing about 0.6% apiece.
I just want to revisit Axis Bank, just see what that boy is up to, and then revisit visit HDFC Standard Life and see what that is up to. HDFC Standard Life, a small dip in the first 1 minute. Let's see if that lasts or no. Thyrocare should be in focus. The buyback at a price much higher than the current market price. A small reaction right now. Let's wait and watch if this lasts. About 8%. It's all over the place. Let's give it some time to settle. Incidentally, Narayan Rudala has picked up from there too. So that stock is looking like having some gains. Let's see if this lasts or no. Dr. Hal Patlab should also come up on your screen in that case. And let's see what's happening there. And not much change. And collateral damage from a perspective of a stock watcher could well be on Max because of what's happened between Axis Bank and HDFC Standard Life. So whether or not the talk is if Axis Bank does go ahead and enter the business or tie up with some other players, then what happens to Max Financials? These Max Group companies looking like starting off marginally lower. Last but not the least, HEG and Graphite India, both the stocks, needle coke import being allowed. Let's see if they are reacting positively. No, not much. Just a flattish start. The currency incidentally. Sorry?
Yeah, the rupee.
Yeah, the currency too, 72.11 or thereabouts, 1.5 now. This would be the weakest level that we've seen on the currency.
Actually, it's at 72.16 now. So yeah, we've made a new record low for today as well.
Okay, so the currency starts off on a weak note. I don't think that the bond yields would be celebrating too much as well. The macro data seem to be slightly, the CAD has widened, just that on a YOY basis, as a percentage of GDP, the number is at 2.4 versus 2.5. However, more on this in a bit. We'll have a conversation about all of this with Sajjid Chinoy a bit later on in the show as well. At about 9:30, we'll be talking to him. But while we wait for that, let's get in Amit Sarkar, who joins in with the top brokerage calls of the day. Amit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Macquarie on Minda Industries. Now, the brokerage has initiated coverage on the stock with an outperform rating and a target price of 550, which suggests a potential upside of nearly 36%. Now, according to the brokerage, Minda Industries has a dominant market share and technology leadership in its core products. Along with this, its future-ready products will gain from the impending shift in the Indian automobile sector. Currently, the company is well aligned to the growth drivers of the Indian automotive sector, and the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compounded annual growth rate of 24%, 28% and 34% over FY18 to FY21 on the back of growth in automotive production, rise in content per vehicle, consolidation of the group business, expanding product offerings and improving capacity utilization. Lastly, the brokerage says that a strong earnings growth and a high return on capital employed deserves a premium valuation which Minda Industries trades at. Second, we have a Citi on GAIL India. Now, the brokerage has raised its rating on the stock to buy from neutral and has also hiked the target price to 420 from 408, which suggests a potential upside of nearly 11%. Now, according to the brokerage, GAIL India has now become a play on rising oil prices rather than its core gas transmission business. Now, rise in LPG prices, which will increase the segment's realization, widening spread in the gas trading business and stabilization of the petrochemical business are the positive when it comes to GAIL India, says the brokerage. Lastly, it says that the year-to-date underperformance of GAIL India offers an attractive entry opportunity when it comes to the company.
All right. So, Amit, thanks very much for that. GAIL India, last 1 year performance has been 27%. Amit, I want to come to you on this one. Do you see, entry point being more lucrative for GAIL right now?
See, from risk-reward ratio perspective, the good entry point would be between in the range of 364 to 368, because the crucial support for a trend reversal that stands at 350. If that gets violated, the recent up move could get punctured. But overall, if you see from a medium-term perspective, the trend seems to be quite positive. If we do not break 350 on a weekly closing basis, the upside target price falls in the range of 425 to 430.
Avinash, what does one do with aviation now?
No, I think aviation will continue to underperform at least for at least 1 or 2 quarters. With a weaker rupee and with the rising crude price, I think this combination is definitely going to impact margins quite severely. In fact, despite the fact that air traffic volume growth has been pretty strong, the margins are definitely going to be under pressure. So I think stocks like Jet, SpiceJet, Indigo, I think all these 3 stocks are likely to come under pressure. Jet primarily will be under severe pressure, considering that they are making desperate efforts to actually raise resources to reduce the debt and improve that operating cash flows. I would believe that in the given scenario, Indigo definitely stands the best kind of stock. But again, from a longer term perspective, in the short term, the combination of a rising crude price and a weaker rupee is going to definitely impact the margins.
Interesting. And well, it's been showing in these aviation companies, though I must say Indigo is off the lows that it hit. I think it had slid to about 875 odd. Now just seeing some semblance of sanity back to above 900. As we speak, and the pre-open rates as they are settling down, we don't have too many big losers or gainers either. Vedanta is looking like it'll start off as the top gainer, about 1% higher. Some IT names might do well. On the losing side, maybe Power Grid, Bharti and some of the other stocks might do okay. But no big trends, but for technology, which could start off another 0.5% or thereabouts higher. Bhavin, any technology large cap name that you would initiate a fresh trade on? Almost all of them look like they'll start off marginally higher today.
Okay, so this expiry, what we have seen is that basically Infosys post going ex bonus has just failed to witness any major momentum. It had showed some amount of positive bounce back just going post bonus. But I think the larger part of the trend still remains positive. One can continue to create long position in this particular counter. Like this space very much. Believe that stock could do now level of 785 to 790 on upside easily. So definitely one should be looking. Stock is currently quoting somewhere in the range of 735 to 740 range. On the downside, stop loss should be close to about 705. So this is one of the stock which we particularly like from IT counters.
Just sticking to IT, Avinash, emphasis the buyback. Is it good to tender at 1350?
I think clearly, I think from a near-term perspective, definitely, some amount of tendering shareholders can make. But I think clearly the company has making conscious efforts to actually reduce its exposure on the HP account. And our sense is that compared to the other large caps and the mid caps, I think definitely, one could definitely see a stronger kind of upsurge in the product-related companies like maybe a Persistent or a KPIT. I would believe that, shareholders should definitely look at these opportunities, considering that the risk-reward in these stocks would be much better than Emphasis.
So watch out for KPIT. KPIT is a good bet.
Yeah.
You're not betting on Persistent?
No, he did mention.
Yeah, I did mention KPIT and Persistent.
Because almost everybody that we've spoken to, maybe because of the valuations or otherwise, has Persistent as a common buy idea.
No, I think in the product category, especially in the IoT space and the the app space, I think Persistent is definitely going to show a stronger kind of earnings trajectory, post FY19. And I think the management is very clear. That would be the near growth driver. So I think clearly, stocks like Emphasis, Neeraj, may not show that kind of risk reward compared to these two, IT names.
Okay. What does Thyrocare's buyback indicate as a signal?
In fact, Neeraj, I would believe that this company, if you see the Q1 numbers compared to Dr. Path Labs, I think earnings growth has been quite muted. So I think the buyback is definitely going to be a short-term trigger. The stock is going to be offered at a much higher price. So in the near term, the buyback would obviously give a better trigger to the price. But what the market would obviously like to know is what kind of earnings growth from the core business comes in, and that is something which I won't be surprised, at least for the next 1 or 2 quarters, considering the kind of pricing in this diagnostic market which is happening, may take a little longer time. So near term, I think you could see a bounce purely on the buyback. But longer term, I think I would believe that it's better to stay away from the stock.
Neeraj, is interesting how most treasury desks right now are participating in special situations like a buyback. They have, because it's easy money. I mean, you're looking at the potential uptake, you get that kind of leg up. But again, that depends upon the kind of tendering that happens and the ratios that come out of it in terms of the acceptance ratio, whether or not it's, for a TCS, probably 86 to 90%, but for the others, it could be a bit lower. So that slight element of risk comes in.
Yeah, in Thyrocare's case, we don't even know whether the promoter is going to tender or not. At least I haven't read that clarity. It's a large buyback. Let's wait and watch what kind of acceptance comes about. But less than 5 minutes to go for the markets to start. Let's tell you all that you need to know to stay ahead in trade today. First up, current MD and CEO of HDFC Standard Life, Amitabh Chaudhry, will take the corner office at Axis Bank after Shikha Sharma remits her position on December 31st.
Boost for HEG and Graphite India as the Supreme Court allows import of needle coke, which forms nearly 60% of the raw material in graphite electrodes.
Sectoral Infra draws up a plan to raise 550 crores for diversification. For this, its promoter will infuse about 440 crores, the stock likely to start off 5% higher.
From the auto space, JLR's total retail sales for August fell 4.9% on a year-on-year basis. Watch out for how this will impact Tata Motors in trade today.
And some key brokerage calls for you. Morgan Stanley downgrades Havells, while Citi upgrades GAIL India.
Lastly, RITES receives a railway contract worth 295 crores. The order is for doubling of railway lines in southwestern region.
Okay, Avinash, just before we let you go though, a company that you are comfortable putting fresh money to work in currently, large, mid, small?
I would believe that, I think within the media entertainment space, we recently met a company called Shemaru Entertainment. I think, Neeraj, very interestingly, the Q1 numbers have been quite strong. And I think in the OTT space, we have been very positive in the fact that this market is going to grow at least 6 more times compared to the traditional media space. And I think this business has been very lucrative, very profitable for Shemaru. Our sense is that this share of 27% could possibly exceed 35 to 40% over the next 2 years. And the management is making all sorts of efforts to actually increase the share here. So our sense is somebody who's looking at a kind of a long-term investment should definitely look at this stock. I would believe that the stock trades at a market cap of roughly 1,300 crores. In the next 2 years, this market cap could actually double, considering that they have a large library of content. And the last 5 years were purely investment years. In the next 2 to 3 years, the management is very hopeful of monetizing it.
What about Hathway Cables? Because that's on a tear also recently.
Hathway Cables, Devina, frankly, they had some news flow did come in that they were in talks with Netflix again, for some sort of content agreement. So I think clearly one would like to see what kind of revenue and profit impact that could make. But considering the fact that the Reliance entry into the fiber to home market has been announced, cable television by itself is going to be on the back burner. So clearly the next couple of quarters is going to be a little weak, on the operational side for Hathway.
Well, we'll watch out. Avinash, thanks so much for taking the time out and being with us and giving us that perspective. So Shemaru Entertainment is an idea from Avinash Gorakshakar's stable for today. They have recently met the management. He's bullish on the company. The management's interaction with us recently indicated business prospects looking stronger than before. Watch out for Shemaru in the session today. But less than a minute to go. And if the pre-open rates are to be believed, Devina will start off marginally lower. Interesting day to have some trades as well.
Well, let's get across to our technical analysts then to give us their top calls. And we'll start off with you, Amit. As we enter into trade this morning, what are you going to be watching out for?
Well, I would be watching out for metals because relative strength-wise, we haven't seen that much deterioration in a metal index. So I would go with Hindalco if on a decline. Would buy it around 237 to 238 with a stop of 230 and for a target of 248 for today's trade.
Bhavin, what about you?
Okay, two things. One is the weakness, initial weakness on Nifty. I would be looking to short the puts, especially below 11,400 strike. So it can be 11,300 as per the specifics of the risk reward of the client. At the same time, looking out for M&M, any weakness in this particular counter should be a buy for this particular stock. Stock ended around level of 974 on Friday's trade, looking extremely positive. And this stock has actually outperformed the entire auto pack.
Okay, so M&M it is. Here's how the markets are starting off. Gentlemen, stay on. We'll just take in opening thoughts from you very quickly. But starting off about 0.25% to 0.5% lower for the Nifty Bank. Doubt that the mid caps and the small caps will be doing much different. So some bit of pressure, nothing too much. The small cap index just about holding on to the green, but the mid cap index about 0.25% lower as well. So weakness. Not pronounced weakness, but weakness nevertheless in almost all of the key indices at the start of the trading day today. Here's how the heat map is looking like. Enveloped by the red, very few ticks of green. IT, if at all, standing out. Some gains to Axis Bank out there. And within the losing pack, I think it's Tata Motors which is standing out as one news-based company. Sun Pharma, some more weakness there. But no clear winners or losers. It is Axis Bank, which is continuing its merry ways. It's had a good run ahead of the announcement that's come out on Saturday, and now about a couple of percentage points higher. So Axis Bank clearly standing out. And select IT names, HCL Technologies, Infosys, TCS standing out, but a lot of red, very little green. Frankly, yeah, I sound like a broken record, but Axis Bank is the only worth one mentioning on the index right now. Let me quickly look at a couple of pockets before I hand it over to Devina for figuring out what's moving around. Some trend makers from newsmakers. This Axis Bank's announcement, what does it do for some of the other impacted parties as well? So Axis starts off about a couple of percentage points higher. HDFC Life does not see a big cut, but remember, it's fallen quite a bit from the recent highs. That is not to say it's a cheap stock, but at 450, 451, not seeing too much of losses. Max Financial too, not seeing too much of losses. I mean, conjecture really as to what happens to Max if and when some deals get entered into, but that's okay. But Axis Bank on a roll, 3.5% higher right now. What else? A couple of other pockets. Some newsmakers, graphite electrode or needle coke purchase allowed, imports allowed, and that's led to some bit of an uptick for HEG and graphite. They haven't had a particularly great month, the last one. So, well, moving up in trade, not bad. Last but not the least, some movers from Friday's session and from last week, rather. So, Aurobindo, Hathway and Network 18. No such luck for Network 18 today, but Hathway continues on its merry ways. 24.5 now from lows of about 15.5. So, that's a remarkable pullback for a sector on which obituaries were written. This is a good move for Hathway Cable. Devina, what are you spotting?
One of the top losers actually is IL&FS Transport. The stock's now down about 10% in trade. We've got IFCI also, which is down about 5.5%. Not a very good quarter, reported a loss of about 300 crores. Stock's taken a beating. It's a small stock. Adani Enterprises is down 2%. You've got Reliance Naval, which is down 2%. Gati, which is down 1.3%. J&K Bank, HCC down 1% apiece. United Breweries is down Shallow cuts, not too big in terms of the broader markets as well. The quantum of stocks are more, but the kind of cuts are a little shallow. So you've got MRPL down about 0.8%, Cox & Kings is down about 0.7%, Capital First, you've UCO Bank, GNFC, Syndicate Banks, and Ensar Technologies are all amongst the losers. Then a quick look at what some of the gainers are. You've got Shrey Infra, Delta Corp up 1%, Hexaware is up about 0.5%, KPIT Tech, VIP Industries, and your top gainers, McLeod Russell, with 3% gains on that one.
Well, interesting. Just very quick thoughts from our technical experts before we let them go. Amit, Harchekar, anything that pops up on your screen as a trade the first 3 minutes?
Well, I would say the opening has been quite encouraging because despite very negative SGX, we haven't opened that much negative. Now, the good thing is we are now seeing some amount of reversal even in Nifty Infra Index. And we think that would be also a key driver for the Nifty. Within that, again, Torrent Power is the one stock where we think there is a possibility that it could go up by 4 to 5%. So we would recommend buying that with a stop of 400 on a closing basis, and target would be around 435.
Okay, and thanks for that. And Bhavin, just very quickly, any trade that pops up on your screen, the first 3 minutes of trade, first 4 minutes of trade rather?
Okay, so Jindal Steel and Power, good amount of strength observed in that particular counter. Already my colleague has spoken about the metal counter. Looks like a good bet. With stop loss of 218, one can go long. Probable target can be around 235.
All right, gentlemen, we'll leave it at that. Thanks very much for discussing all your stock ideas with us this Monday morning. Appreciate your time. Let's go on to another market voice. Sindhu Samir, co-head of equity sales at Emkay Global Financial Services, is here with us in the studios. Good morning, Sindhu. Thanks very much for joining in. So, you know, what have you been focusing on in the current market mood? How do you read into it? Are there pockets of interest?
Definitely. See, the last time we came here, from there the market has moved up substantially. 1 or 2 months back, it was being accused that the rally is narrow. But now the rally is no more that much narrow. Of course, I mean, I'm not talking of what happened in the last 1 week. So we have pharma participating in it, we have IT participation in it. So the rally was narrow 2 months back, 1.5 months back, but now it's getting broad. So I'm not advocating that there is a rally in the offing, but the market levels are now having 4 legs, 5 legs. Initially, it had 2 or 3 legs to it. So rally is definitely getting broad, or the market levels are getting broad, but at the same time, macro is getting challenged. Of course, the external macro, rupee and all this, these are definitely causes of concern. But surprisingly, in last 1 week and last to last week, we had a GDP data of 8.2%. Surprisingly, this is no more a headline news. So we have a challenging external macro situation. There is no doubt about it. But at the same time, there has been a rebound in GDP, and the rebound is much more than what was expected. It is much more if you adjust it for the base level also. So there are some green shoots in the economy. At the same time, the macro seems to be challenging on the external front, definitely.
But how much of how much would you weigh in on this in terms of the external global challenges as well as our own internal challenges versus the kind of earnings performances for most of the companies here, which have actually given them that leg up? So in terms of risk reward, what would you give more weightage to?
Okay, let's talk of risk and reward. I being more of a micro focused person. This quarter's number, in my personal reckoning, has been one of the best in last 5 or 6 quarters. There has been earnings momentum. There have been volume growth, which is very important factor to look at. What has immediately caused some kind of concern is, again, what I'm saying is the external macro point of it. But put all things together, and there has been a leg up in the GDP, it is a fairly balanced kind of a situation. So the markets are 19 times, 20 times forward. They are not completely out of tune what's happening. 18-19%, what it offers is that if an individual is not focusing on the indices, there is a clear opportunity to pick up certain good, great businesses and remain invested in it. Of course, if the market was 16 times forward, GDP was 8% growth, it would have been an ideal mix. But then markets, after 2008, when the interest rates were brought down so low, does not offer those low-hanging fruits and ideal mixes for the investors to come in, especially the individual investors.
Well, Sindhu Samir is an eclectic mix because he heads equity sales and has to talk a lot about the short term, but is a big Warren Buffett disciple as well and focuses on long term investing. To Sindhu, so currently when you're going out and talking to your clients, right, because as a head of equity sales, you need to talk to all your large clients, when they are talking about where is it that they put fresh money to work, and if they put fresh money to work, what do you tell them?
So, I mean, they have their own prerogative where to invest, but the focus primarily seems to be quality.
Even now? And even from your end too?
For our end also, and will always be for selling quality.
But quality is coming at a big price.
Yes, quality is coming at a price, but for an economy which is 2.6 trillion, which will potentially grow minimum 7.5%. And I'm not saying it can even grow at 7.6%. So you are getting a 7.5% GDP growth economy, 2.6 trillion in size, more than 5,000 to 4,000 kind of equities which are being listed on the space.
Right.
Quality will definitely be at the vanguard. And yes, the regulator has made it there some changes. So the premium on quality, which was always there, can get accentuated. That's
so now quality has 4 legs. Sorry to come in, but I'm just trying to get a sense from you. Now quality has 4 or 5 legs, right? IT quality companies now starting to perform well. Pharma quality companies now starting to perform well. Consumers quality companies starting to correct a bit from the heady levels. And financials have been all over the place. Private sector, corporate facing banks are now starting to. So which leg or within the quality bucket is worth putting fresh money to work at these levels with the emerging market stress that we have right now?
So at the margin, definitely pharma seems to be the space where we had relatively affordable valuations, and there is an earnings momentum which is now setting in place. So to clearly answer your question, pharma seems to, and pharma is not a very small sector to be in. At the same time, BFSI, which happens to be 36-37% of the indices, in itself is getting variegated. There are multiple new streams coming in BFSI also. So it's not that we need an incremental 6th sector to come in. These sectors in itself offer so much of variegation. There are so many multiple hues where you can put your money in. Look at pharma. What happened? It started with the 3 bellwethers, and now it is getting down and is spreading far and wide. We had a very affordable valuation. The sector has dropped nearly 25 to 30% of the earnings in last 1 or 2 years, and then the momentum is coming back. I'm not saying that this is a contrarian play, but these contrarian stocks or sectors are now getting mainstream. So what we are talking is, yes, 1.5 to 2 months back, it was a very narrow rally and it was a concern, but now it's getting broad-based.
So in terms of, like you've been pointing out, and Neeraj also said, in terms of the heady valuations for FMCG, does one then start rebalancing the portfolio and start reduction in terms of, removing some money out of these stocks and putting them into stocks which you just mentioned?
Absolutely. So first of all, let's talk of FMCG. It seems to be my favorite sector because whenever I come here, FMCG gets discussed.
Interesting.
Now look at FMCG. There are 2 parts of it. The organic business performance of FMCG companies, which even had 1 or 2 companies reporting 15 or 16% volume growth. And what better vector do you need than to look at it? That's the organic business performance of FMCG. We have seen even ROEs getting better by 1 or 2%. So you have a volume growth ROE. What we are saying is that the valuation looks fairly ugly. Let's use a dramatic word, ugly. But the point is this is not like a dot-com bubble of 2001 and 2002 where business models, actually the business melted. So there is no fear of business getting vaporized and we have nothing but a pure valuation left. So these businesses are very robust. They have high ROEs. They are perennially cash-throwing machines. So what we are talking of perhaps of a time correction. We are not talking of that business model. Actually, people were fools to go and chase these models. No, they have performed, and they have performed over decades, over multiple geographies. What we are talking is of a valuation. So we can see a time correction. A potential fund manager might be tempted to take away some weight and put it somewhere else also. So that is for the FMCG. And second is that what happens to other sectors. And second is in BFSI, again I'm coming back to BFSI, there are multiple new verticals getting into BFSI. Lo and behold, we are 36 or 37% of the Nifty is now sitting in BFSI. So calling it purely as BFSI is not the right thing. So we are saying, I'm not selling a case for a bull market. That's not my call. But if things do not get at the margin inferior, we have reasonable opportunity to invest in good companies and make a significant difference to our portfolios.
You know, I would just like to come in on the point you made about FMCG. Even within the FMCG pack, if you see a valuation gap, there's a big valuation gap between an HUL and an ITC. But still no one will recommend you to go ahead and buy an ITC. They'll still tell you to go ahead and buy an ITC.
Anyway, I'll not name any company, but there has been a price performance in one of the stock which we have seen. So it has also risen up. And then the question comes is that among FMCGs, in the overall superset of FMCGs, the subsets have a different business profile. So somebody is sitting at a 24% ROE, others are reporting at 50% ROE. So there will be a segregation among that. So perhaps the examples which you have given also needs to be sifted with a fine-tooth comb in terms of what kind of...
So it's not pure valuations, you'll not just look at it.
So it is valuation, but valuation getting justified on a certain business performance, certain ratios, certain cash flows, certain ROEs and all that.
Interesting.
And that's what the doctor ordered.
Well, I don't think too many people are complaining with the rally in the last couple of months, the nature of the rally. Sindhu, I just want to dwell a bit on this varied use of financials and BFSI that you spoke about. Now, there are a couple of large spaces that have gotten created in the last 9-12 odd months, life insurance and now asset management companies. Are you sanguine about the prospects here, both these pockets?
Absolutely. I mean, life insurance, first of all, let's talk of the biggest bugbear these days. Whenever I go in any meeting, there are two things which are definitely getting discussed. One is disruption, other is fragmentation. Now, let's talk of life insurance. What kind of disruption can come in anybody's life by not ensuring his well-being? I don't think so. Even if any kind of a disruption takes place in any kind of a sector, people will overcome their fear to insure themselves. So I don't think so any kind of a disruption can hit an insurance business. Now India, the population being 1.25 billion, and more people are getting into consumption space, our per capita income, nobody seems to be talking that between last 4 or 5 years, how much the per capita income of India has grown. So the more you grow rich, the more you feel the urge to secure yourself. So I don't think so there is no threat of disruption on the insurance space. Maybe the delivery of insurance might get more app-based and all those things. So there is no disruption taking place. India is horribly underinsured, both at the institutional level and at an individual level. So requirement of insurance is there. Second is the asset management business. So I will not talk any name in the asset management because they're hard.
There are only two.
Yeah. So look at it. Let's contrast asset management vis-a-vis the insurance space. Asset management at the moment might not be looking affordable in terms of valuation, but it is a non-linear model. Compared to insurance, the capital requirement for an asset management firm is very low. It has a non-linear character to it. There is overwhelming pressure on financialization. Just a generation back, the only instrument people used to save used to be fixed deposits of one. And today, we are spoiled for choice. Asset management being one of them.
But we are still underexposed in the equity market.
Exactly. So it's more about the non-linearity of the model. It is about the high ROEs coming in. Of course, the valuation looks not very comforting, but if you can stretch your vision 3 years, 4 years, 5 years, there is little wrong. There is not a big fear of a capital loss happening out there.
The mindset is also changing from the mom and pop saving instruments like gold, which has given you absolutely no returns, to now the prospect.
So I have a very favorite example. When I started my career, my father told me to rush and first open a PPF account. When Neeraj started his career, he immediately opened a SIP account. I don't know.
Oh, that's true.
Yeah. And when my daughter will be joining her job, I'll say just focus on SIPs and nothing else, and life is set. So that is a kind of difference which has taken place just over 2 or 3 generations in India. This happened in 1950s, 60s in America. This is happening now.
Interesting. So Sindhu, do you reckon we'll have a happy Diwali? From here on until the next couple of months, with all the pressures surrounding the global markets, are we in for a small dip, which the fears of which it started
I
last
have a
week?
metaphorical answer to it.
Give me a straight answer for once.
Happiness is not an occasion, it's an attitude. For an investor who is long-term in his nature and character,
we'll find a dip as an investment opportunity.
Absolutely.
Yeah. So would you reckon that we'll get an investment opportunity, is my question.
Investment opportunities for a smart eye are always there.
How about a non-metaphorical answer to that?
I think 1 year from now, with the macros improving, GDP getting a momentum, I don't think so. There is a huge risk, which is, and I love to talk about risk. So I don't think so. At 19 times forward, we are sitting at a waterfall kind of a level. The global debt levels are not that scary. Remind you, just the previous crisis, that is 2008. It's 10 years now. Was primarily led by the debt levels. So subprime was a sort of a debt. So it's not that scary as of now, but markets are programmed to throw black swans at us. To protect ourselves from those black swans, we need a margin of safety. So probably even if you're not feeling comfortable about the market levels, then we can look at asset allocations. So we can reduce the element of equity in our asset allocations, take it somewhere else. There are multiple asset classes, and just protect ourselves. But the point to say no to equities, last week a correction happened, is not the most prudent thing.
Got that. Sindhu, thanks very much for joining in. Really a pleasure chatting with you this morning and getting your views.
Thanks, Sindhu Sabir. Well, take a break on the note that the markets are 0.5% lower. On the other side of the break, we talk about the precise thing that we are talking about, which is the macros, the impact of the weakening rupee on rising public debt, with Sajjid Chinoy, JPMorgan, and try and take a look at the challenges and opportunities for InfoEdge with Managing Director Hitesh Oberoi.
Good news, got a promotion and a damn good raise.
Congrats, बेटा.
वाह, रेज? अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
Dreamers. They're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are no different. They are you. When you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
Kerala is tiding over the worst calamity that the state faced in a century. The intensity of the calamity and the losses suffered thereby are unparalleled. A preliminary assessment pegs the loss at around of rupees 20,000 crores. It is a humongous task to undertake various tasks of rehabilitation and reconstruction. Only with the wholehearted support and cooperation of all of you, we can rebuild Kerala. Your contribution, however small, will go a long way in achieving this goal. Please contribute to the Chief Minister's Disaster Relief Fund. We shall overcome.
Back with us on Indian Open right here on Bloomberg Quint. India's current account deficit went to 2.4% in the first quarter of FY19. This number is wider than the previous quarter, but one can choose to take heart from the fact that it was 2.5% in the same period last year. One of the reasons for the jump can be attributed to the weakening currency and, of course, the crude prices the way they are trading at. So where does all of this leave India's finances? What do you expect from the print coming up? And if all of this a potent cocktail for another rate action from the Reserve Bank of India come the next policy? Joining us to talk about all of this is Chief India Economist at JPMorgan, Sajjid Chinoy. Always a pleasure having him. Sajjid, so good of you to take the time out and speak with us today. Good morning. What do you make of all of these variables and the impact that it has on rate decisions from an India perspective, and then we of course move on to the Fed as well?
So let's just step back and try and assess what's been happening. I think what you've seen in the last 4 months is two distinct phases of stress. Emerging markets, after experiencing this Goldilocks environment of 2017, where global growth was strong, the dollar was weaker, capital flows were flooding in, the environment has become much more vitiated. And what you're seeing is essentially two phases here. The first phase, I would argue, somewhere from the middle of April to early August, was one where there was broad dollar strength. The dollar index was rising across the world. All currencies, the euro, emerging market currencies, especially those with current account deficits, were coming under pressure. So the rupee move in that period was largely mirroring dollar stress. I think what's a little bit more worrying is over the last 3 weeks, you're seeing a second distinct phase occur. The dollar index itself has kind of weakened or hasn't strengthened as much, but emerging market current account deficit countries, right? Countries that rely on external funding in this environment, Brazil, South Africa, Turkey, Indonesia, Argentina, India, have all seen their currencies come under sustained pressure, in a way suggesting that tighter global financial conditions are placing a risk premium, or markets are commanding a risk premium from those countries that need financing. So we have to look at the rupee move in a much more global context. This is not an idiosyncratic India-specific move. All emerging market currencies are coming under pressure. What's a little bit worrying is this is happening despite a weaker dollar. So in a way, we get a double whammy. We get a weaker currency, but because the dollar is weaker, oil prices are higher. So you get higher oil prices and a weaker currency. Let me just make two final points. One is that the rupee has not underperformed. There is this notion which says India is the worst performing currency in Asia. That's an invalid description. We should be comparing ourselves to current account deficit countries. And if you look at the larger emerging market universe, India is kind of in the center of the pack over the last 4 months. We should not be comparing ourselves to Asia, which is largely made up of current account surplus countries, except for Indonesia and Philippines. Very last point, Neeraj, I think what you're seeing on Friday night is a continuation of US exceptionalism. Strong jobs numbers, unemployment rate is below 4%, but the most important part of that report is we're finally seeing wages pick up, right? The long-awaited increase in US wages, they went up 0.4% month on month, and a year ago, wages are now running at 2.9%. So that's going to create more stress here, because now more conviction that the Fed moves in September and again in December.
Sajjid, actually, so Akash Prakash wrote a piece wherein he mentioned that according to him, the markets by and large, or market watchers, are underpricing the impact of wage growth and the pace at which it comes, which might force the hand of the Fed, if the Fed doesn't want to do it on its own, the pace at which Fed would go ahead and raise rates, and thereby the impact that it has on all asset classes. Now, we of course wrote about it from an equity watcher's perspective, but it naturally has an impact on all asset classes too. How big an overhang, if I can use that term, Sajjid, would that piece of the puzzle be for EM's macros at large and for India and the currency in particular?
It will be a very meaningful headwind here. I mean, JPMorgan has been saying for a while that bond markets in particular seem to be kind of underestimating the pace at which the Fed is going to move. Till recently, bond markets only had 3 hikes for this year, a couple for next year. Our sense is there would have been 4 hikes this year and maybe 4 hikes next year. So the difficult juxtaposition is you've got US exceptionalism, that the US economy is roaring along, and the Fed has to respond to growth, unemployment, inflation pressures there. At the same time, you've got a lot of emerging market stress. So I think this will be a meaningful headwind, because what you find is kind of, one of 2 things typically drive capital flows to emerging markets. One is growth differentials. The higher is emerging market growth vis-a-vis developed market growth, the more capital they attract. The second is the US dollar. So if the Fed keeps marching along, and that eventually causes the dollar to strengthen more, that is going to impinge on capital flows to emerging markets. And when that happens, current account deficit countries that rely on capital come under particular stress, which is what you're seeing in the last month. So this is going to be a very tricky, think of this as a kind of unraveling of the very benign monetary conditions for 4 or 5 years, where there was massive expansion of balance sheets around the world. Now the shoe is on the other foot, and some emerging markets with kind of softer underbellies, Turkey, Argentina, you're seeing the pressure in those markets. So it is going to be a challenging environment for the next 4-6 quarters, and I think emerging markets have to come back to orthodox policies, fiscal and monetary.
Okay, and I want, that will be my last question to you, Sajjid, but just before that, again from a global viewpoint, would India fare a little bit better, and with an assumption that some of the damage on the currency is done, maybe some is still left, and I don't know if anybody can really pinpoint as to what levels would the rupee slide down to, if at all, but let's work with an assumption that some of the damage is already done, and work with an assumption that at some point of time in the next 6 to 12 to 18 or 24 odd months, what is in the realms of conversation right now, which is India disassociates itself from being a part of the EM pack, which it has been for all these years, and starts getting looked at as an individual country to which allocations are done, because we are a reasonably large or a very large economy now. At some point of time, we won't be a part of the EM pack allocation, but an individual country allocation as well, and a country that is showing growth, which is fairly strong. I mean, the latest GDP print is reasonably strong as well. Does that help India cushion some of the pressures that will come in over the course of the next 4 or 6 quarters that you alluded to?
The answer in one word is absolutely. I think it's very important to make 2-3 points. Firstly, we should not panic. There's a lot of frenzied reporting every day about the rupee being at all-time lows. It makes it look like India is particularly vulnerable or the move is idiosyncratic. That is not the case. India's macro fundamentals today are much better than they were in 2013. Inflation is half the level it was. The current account deficit, I'll talk about that in a second, has gone up compared to last year. But even if it's 3% of GDP, it's meaningfully below the 5% we saw in 2013. It's very important that the fiscal be met this year, but the consolidated fiscal deficit is still meaningfully lower than it was, 5 years ago. And FX reserves are 1.5 times our gross financing requirements over the next year. That is not lost upon markets. India's fundamentals are much stronger than 5 years ago, and as you pointed out, growth, in a world where growth is at a premium, for a country to grow at 7.5 to 8% is very meaningful. So our fundamentals are better, But I think 2 points I'll make. One is when you do have a current account deficit of about 3% of GDP this year, the first quarter was 2.4. We expect the subsequent quarters to increase. And you're looking at an $80 billion current account deficit. That will be hard to attract in this environment, not just for India, for most markets, because FDI flows are typically 35 billion, NRI deposits are about 15 billion. So 50 billion is your stable money. You've got an $80 billion gap, so there's a funding gap over there. Now that can easily be funded by a drawdown on FX reserves. We've got more than enough, so there should be no panic. But because India is a current account deficit country, in this environment, all current account deficit countries are treated as the same asset class. Once the initial pressure settles, what you find is markets become much more discriminating. And India's stronger macro fundamentals compared to some of these other countries I mentioned, South Africa, Turkey, Argentina, will shine through. India's growth premium will shine through. We just need to weather the storm by going back to first principles. To the extent that the rupee results in more inflation, we'll have to see a little bit more tightening. It's very important that the fiscal deficit be met this year and fiscal policy continue to consolidate, because ultimately the current account is nothing but investment minus savings. The faster we get fiscal consolidation, the quicker the current account will narrow without investment or consumption having to take a hit. The last thing I'll say, Neeraj, is that I would not regard the rupee move as being damaged, quote unquote. I think that in a way this is a healthy correction. India saw 20% real appreciation over 4 years. That, in my view, affected the competitiveness of the underlying economy. We've seen a 6 to 7% real depreciation this year. This is a healthy correction aided by global developments that over time will certainly help exports and help narrow external imbalances. So I think we've got the right policy mix. We just need to avoid panicking. And I don't think policymakers are panicking. So think of this as a global move, and when the stress does turn around, India's stronger fundamentals will show through.
Okay. Last question, Sajjid. An October hike firmly on the table, or do you believe it's a combination of things? A hike, some drawdown in reserves, and maybe raising some money via NRI bonds. All of that happens.
Yeah. So in this new equilibrium around the world where there are tighter global financial conditions, I think emerging markets have to respond using 3 instruments. Around the world, we'll see higher rates, tighter fiscal, weaker currency. I think that's the right policy mix, and I think that's what Indian policymakers are pursuing. The CPI print that comes out this week is going to be soft. It's going to be close to 3.5%, but largely on food prices remaining muted. That's water under the bridge. I think the RBI has to look forward and assess, with oil between 75 and 80 and the rupee having moved down, what are the inflationary impacts going forward. And my sense is the likelihood of a rate hike in October, if the currency remains under depreciating pressure, is very meaningful. I will say at this point we should avoid any ad hoc announcement like an NRI bond. As I said, India's FX reserves are more than enough. Any ad hoc announcement will just give the impression to global markets that, policymakers are panicking, things must be worse than they actually are. We don't need that. We've got plenty of reserves. Let's be orthodox. Let's tighten rates if we need to, stick to our fiscal, compress the current account, and if we have some drawdown in reserves, that's precisely why you have these buffers in the first place.
Awesome. Sajjid, it's so good chatting with you, as always, I might add. And, we look forward to chat to you post the policy as well. It will be an interesting policy, maybe a deviation from what everybody expected to happen in the policy a couple of months ago. But thanks so much for taking the time out and speaking to us today. Sajjid Chinoy, and always a pleasure having him really on the show. Okay, the currency at lowest levels, and we just spoke at length about it. The other corporate conversation that we want to have today, and a quick one, we in the research team and the editorial team, we're talking about the competition that comes in for a Zomato because of the strengthening of some of its peers and the fundraising that, say, for example, Swiggy is doing, what some of the other companies in that space are doing. Infurge, of course, much more than just a Zomato. But let's talk about all of that with the managing director of the company. Remember, Swiggy's acquired Scootsie, so that is the other bit that is happening in that space. Hitesh Oberoi, the MD and CEO at Infurge, joins us right now on the show. Hitesh, so good having you. Thanks so much for taking the time out. In my office as well, there are a lot of people who use all of the three options available right now. And when you look at the business models of all of the three options right now, all of them are trying to make do with something or the other in order to stand out. Now, how competitive a landscape has the environment around Zomato become over the last 6 odd months? Because one is Swiggy acquiring Scootsie, but that's not all. They are raising money. Uber Eats is now spreading its wings as well. And while you arguably remain the leader, how competitive has the landscape become?
Well, India is a growing market. I mean, just to give you some statistics, Zomato was, they had 1,500 delivery boys a year back working for them. Now they have 45,000. So the numbers have grown phenomenally over the last few months. Zomato is, of course, much more than food delivery. They have a restaurant listings and review business. They have international presence, and they're also into food delivery. But it's a growing market. If you look at China, India's just sort of getting started. I think the Indian market is maybe 1/10 or 1/20th of what the Chinese market is today in terms of size. So we have a long way to go, and of course you will see a lot of competition because it's a huge market, and nobody wants to give up in a hurry.
Interesting, Hitesh. So tell me, since you mentioned that, when you look at the growth prospects for a Zomato, and I understand that it's a lot more than food delivery. I mean, beyond it all, I'm a Zomato Gold member myself, and a very happy one, I might add. My question to you is, when you look at the size of a business like Zomato 5 years out, do you envisage it to be multiple times what it is right now, purely because of the scope available within those 2 or 3 categories that Zomato caters to?
No, absolutely. I mean, growth in Zomato has been on a tear for the last few months. And the company is investing more and more in its business. Like I said, they're expanding to new cities. They're hiring more delivery boys. They're adding new products and services. I think food habits are changing. People are sort of ordering in more often. People are eating out more often. So it's a sort of mega trend as well as far as the Indian economy is concerned. As incomes grow, people want to spend, and there aren't too many other avenues to spend in India. So people end up splurging a lot on going to malls, eating out, ordering in. So I think it's a long-term trend, and the market is only going to explode going forward. Companies like Zomato and Swiggy are just getting started in our view.
How has work been overall for the business, Hitesh? I mean, we'll be, of course, talking to you post your quarterly numbers as well. But now a lot more names or associate companies or partly owned subsidiaries which were never in the realms of conversation until a couple of quarters ago are right out there. How is business shaping up by and large?
It seems like, I mean, again, these are very early days, but it seems like the overall economic outlook is improving a little bit. And as you know, our 2 big businesses are jobs and real estate, and they're both indexed to the Indian economy. And as the Indian economy improves, these businesses will improve a lot faster. We've seen healthy growth in jobs over the last few months. Even the dust and the storm around IT companies has settled down. IT companies are also hiring now. They are at least hiring a lot more than they were hiring maybe a year or a year and a half ago. And even in real estate, we have 99 acres that's been doing really well for the last 6-8 months. Growth has sort of been in 30-40% range. And that is also because the real estate market is also sort of maybe not out of the dumps, but at least not declining anymore. Issues like demonetization, GST, RERA are now firmly behind us. And so we are very confident, of the prospects of the company. But of course, the GDP sort of growth has to sort of stay at these levels or get better from here on.
I was actually going to wind up with that question, Hitesh. You would arguably be a lead indicator and not a lag indicator of this. The 8.2% print on GDP, has it already started showing in your, I mean, when you chat with your vertical heads or each of these businesses, have they already started showing signs of that traction? And is the expectation that during the close of the year, the trends are looking a lot more stronger than they have looked in the last 18 to 24 to 36 months?
Well, anecdotally, yes. So when we speak to our salespeople, they are a lot more confident than they were maybe a year ago. Like I said, issues like GST. I mean, last year Q1 was impacted because of the GST rollout. Demonetization had an impact on the business for a few quarters. There was confusion because of RERA as well, especially on the real estate side of our business for a few months, because there was a lack of clarity on who was allowed to advertise and who was allowed to launch projects and so on and so forth. So all these issues are now behind us. And therefore, things are beginning to look up a little bit, is what it looks like. Of course, one has to watch out for the macroeconomic situation. That may be getting a little sort of out of hand. We don't know. But yes, anecdotally, when we speak to our sales teams, when we speak to our customers, they sound a lot more bullish than they were a year ago, both in jobs and in real estate.
Which is so good to know. And if the ancillary businesses contribute, then it might be a really good year for Info Edge. We certainly hope so. Hitesh, Oberoi, thank you so much for taking the time out, giving us that quick lowdown. We look forward to talking to you post your quarterly numbers as well. That's Info Edge, and a confident Info Edge, I might add. The market's not looking all that confident. No alarm bells as yet, but 0.5% or slightly over 0.5% for all the key benchmark indices. Big caps and the small caps too should be under a bit of red. Let's take a break. In fact, wrap it up on this leg of Indian Open on that note. Up next, though, is the FNO show with all the action. And at 10:30, we bring you a BQ Learning special on securities transaction tax on derivatives with Chandan Taparia. Stay tuned.
Good news, got a